Management and 307 Financial. Welcome back to another episode of Retire with Oakleaf. Today we're talking with Matt Bufflett, an advisor in the office with a CFP and is also an enrolled agent who kind of heads up our tax prep area. And we thought it would be interesting to take, since it's the beginning of the tax year coming up very quickly, to talk about things we should be thinking about for tax season. So with that, Matt, let me ask you, we're just about to turn the page on 2025, moving into 2026. What are the things that you are talking to clients about in terms of helping them prep and making sure that they're efficient and effective during the tax season?
Absolutely. Thank you, John, for that introduction. First and foremost, I think it's really important to connect with your tax team to ensure you have an understanding of what you need to gather. Some of the biggest mistakes and pitfalls that we see happen both in the process and on client tax returns is there's documents that are either not included that should be included, or there is not the full picture on one's tax statement. There's all these different times where these reports are generated by these institutions, and sometimes being an eager beaver to file your tax return isn't always the smartest move to make sure it's reflected properly on your return.
So you're saying maybe be patient and get into the March time frame to collect all the necessary documents?
Indeed, and I think that goes hand in hand with the continuous joke of nobody really wants to pay Uncle Sam. We all, I think, believe that we pay our fair share, but this really does come into a patience game, especially if you have many different streams of income. If you are involved with corporations or you have income coming from trusts or multiple brokerage accounts, a lot of these forms aren't ready until early February, and especially if you have income on K1, so trust, corporations, etc., those usually aren't even filed, if you're lucky, until mid-March, and sometimes those are even on a very delayed portion. So if somebody has a lot of income from those types of structures, they could be filing their return on extension in May, June, etc. But the one thing I do want to mention is when one does go on extension, this is sometimes a costly mistake that we see, is you are extending to file, but it's not your extension to pay. So you do have to work with your tax team to ensure that you're meeting safe harbor rules, you're getting in the payments you need by April 15th, so you're not saddled with a larger surprise than you'd like by the October deadline to file that comes with underpayment penalties and things of that nature.
Yeah, that's not the fun part of tax season, is it?
Not at all.
So the last time we got together, we talked about end of year tax tips and strategies that we were employing, especially with the new tax regime that we have coming up in 2026. What are some things you can talk about that now, looking forward through 2026, that are important that you're talking with clients about in terms of this new year, looking forward, things that we can change or we should know about or anticipate?
Absolutely, and I think that is a nice transition into how we view the whole process of tax planning and the facilitation of tax filing in general. Is it really should be a year-round engagement. This is something we don't just think about in December or January to April. This is something you should be considering throughout the year as life changes, but also whether it's positive or negative business changes. There were a lot of changes in July that John had mentioned in the tax bill that were of benefit to a lot of people. So one of the big ones was the increase in the SALT cap from $10,000 to $40,000, depending on your income. There were some additional deductions enacted for folks over 65. And these are opportunities, at least we view them as opportunities, to say, hey, let's take some more gains off the table. Or we now know that we can take a little more profit from this trust or the corporation because we have a higher SALT cap. So that's not going to be taxed as much, or we can do an additional Roth conversion above and beyond what we were thinking of. But again, these are decisions that we prefer to make, not on December 31st. We prefer to make them in the 11 months prior to that, so that when tax season rolls around, we have a really good idea of what the return should look like. And hopefully it's a less painful process than it was before. Of you think of just that scene of just documents all over the table and trying to understand what's important and what's not.
In the last decade, real estate as an investment asset it is always an important position. We all own real estate, whether it's our personal properties or investment properties. But the tax ramifications around real estate have really changed. And can you speak to that a little bit about we have a lot of higher net worth clients who own real estate, but a lot of them have kind of realized that the passive losses that they thought they could use against ordinary income, they're not able to. How has that changed, our perception in terms of where real estate fits in and how we strategically use the tax side of it?
Sure. Very good question, and I think it's very timely as well, because just with the onslaught of social media outlets, there's a lot of hype around real estate and passive income and using it to offset other income. There's been a lot of hype around that, and I think just blanket statement in general, we always say everyone's situation is different, so you do want to make sure you're consulting with your tax team to ensure this fits your circumstances, because again, this isn't not giving tax advice here, but we do find that there is a lot of misconception around what kind of real estate people own and how that can affect their savings on taxes. So typically, if somebody's not has what's called a real estate professional status, which you have to meet a lot of material participation and hours of work in real estate to qualify for, if your income in general is over, call it low six figures, low hundred thousands, and you have losses from real estate that are passive, you typically cannot use those to offset any active income, which we see a lot of folks who are high earners, and they hear about real estate being really good for sheltering some losses and saving on taxes. They'll go and buy a multifamily, or they'll go and put in for an apartment building that's their buddy's building on the construction side, and they realize when they go to file their taxes that they sometimes can't use as much, if at all, any of the losses that are generated, because they make too much income in other areas. So it's really important that you do consult with your tax team and understand the rules of the game, if you will, so you're not left with not only a costly real estate endeavor, but a costly tax bill at the end of the day.
So before you make a purchase or before you make changes, understanding how those changes affect your tax situation is a key.
Absolutely. And I think timing as well, if you do have the ability to, because there are some loopholes in the tax code with short-term rentals and material participation, et cetera. So you want to make sure you're taking advantage of opportunities where they're presented, especially timely ones. So, this year there was some new depreciation laws that were brought back with the One Big Beautiful Bill that need to be taken advantage of in the first year. So it's really important to cue in your financial team ideally as soon as possible, and that usually is before something's even purchased, to ensure that the proper planning and timing of events can go into effect.
Do you see any opportunities in these changes, timely opportunities for real estate or any other asset class that is something we should know about?
I think in general, not to blanket answer, but it does depend on what your outcome is. If the intended outcome is income, of course, real estate can be a very, very rich endeavor. Again, depending on what type of real estate you own and how much of it is. From a tax standpoint, again, it is important to understand what you could potentially use from a loss standpoint. And of course, where that is going to help you. If you have enough income and you're really looking for diversification, that's one thing. If you're looking for more income, and real estate can also check off that box of diversification, that could be a great combination to have. And thirdly, if you do have the ability to either yourself or your spouse take advantage of some of the tax benefits that real estate provides, that can be a really nice trifecta.
Great. Matt, we have a lot of clients who invest in real estate, and they do that through Airbnb or other platforms. Can you speak a little bit about that? Did the new tax laws change any of that? How does that potentially fit into somebody's overall financial well-being?
Sure. Very good question. And again, this is a topic that has been very popular in the last couple of years, with a onslaught of Airbnbs and vertical properties everywhere, especially in vacation spots. And here in Rhode Island, Newport and Narragansett are flooded with them. And we do find that a lot of people are utilizing them in a short-term basis. In general, to be on the safe side for the tax code, it's renting it for less than 7 days, because at that point it's a short-term rental, and there are it does open the door for more potential tax savings via the losses and depreciation that you can take on those properties. But again, real estate in that endeavor, in my opinion, you have to check a couple boxes. You, one, either need to have the time to handle it or hire a property manager to do it, and that's, of course, in a cost. Secondly, you have to understand the tax benefits or implications to doing this type of endeavor. And thirdly, you got to decide if you need the income and diversification, because those are areas that all need to be taken into account, right, John, when we zoom out and look at a client's entire net worth situation, not just what's in their investment portfolio, not just what's in tangible real estate assets, but what makes up the whole allocation.
So kind of reviewing what you just said, there's an opportunity for clients to look at a very short-term rental of 7 days or shorter. That is, that when one thinks about renting out for Airbnb, that's a pretty short period of time, but that's the most attractive from a tax point of view. And then going from 7 days or longer, that's when it becomes more complicated with what you can write off and what deductions you're allowed to take.
Correct, exactly. Again, depending on your material participation, whether it's passive activity or active activity, these are all things that you need to ensure that you're reflecting compliantly on your tax return. And this is something where, again, you're having your tax team and your wealth management team integrated becomes that much more important, because there can be communication to understand what's possible and what's not before, again, properties purchased or there's decisions made that could be more costly to unwind.
A lot more complicated than it used to be.
Absolutely.
Great. Well, thank you, Matt. We appreciate your time today and your insights on all things taxes, and we'll look forward to getting back together again in the future.
Absolutely. Thank you, John. And of course, if there's questions that are related to your specific situation, we're always happy to chat with people on a one-on-one basis.